Good morning or good evening, and thanks very much for joining, and thanks to Super Return for organizing this. My name is Steve Moseley. I head alternative investments at the Alaska Permanent Fund, and the topic today, the question I've been asked, and which I'll answer, is RLPs, and to what extent RLPs, and to what extent is the Permanent Fund in particular deploying capital, and how's that affected by the economic environment today. So I can tell you a little bit about what I've heard from other LPs. I can tell you exactly what our plan is going forward, and I'll do that. I have 6 or maybe 7 slides. Those are mostly to remind me what it is that I wanted to talk about. And then I think we've got the time, and I think we've got the technology for about 5 minutes of Q&A at the end. So 15 minutes of talking, 5 or 10 minutes of Q&A if you can accommodate that. And so if you do have any questions, please remember them, or maybe you can even text them along the way. I think we may be set up to field questions along the way, and I'd welcome that. So jumping right into the slides here, I'll start with 2 slides on the Alaska Permanent Fund. I won't spend much time on them. I don't think it's the most important part of this conversation, but it may be important context for a couple of reasons. One is that we're sort of a peculiar entity, maybe unique. That is to say, we're typically characterized as a sovereign wealth fund. We actually function a little bit more like an endowment or foundation. I can say we're definitely not a pension fund, although that seems to be a common misunderstanding. And the structure and organization and our purpose obviously has relevance to how we're investing and where we're investing. And then I'd add to that also that we're relatively new to private equity. The program is about 12 years old, but we didn't insource it until about 7 years ago, and that also has implications, of course, for how we're investing and where we're investing. So moving on. I said that we were fairly new to private equity, and also I'm showing a target of 19% a few years out here on this pie chart, and both those things are true. It reflects the history of the program at the Permanent Fund, which is essentially this. In late 2004, we launched the program through a fund of funds or separate account structure. And I would say that the separate account managers did a good job identifying managers and launching the program, but their mandate was small. So they were deploying small dollars, and they ran into the headwinds of the great financial crisis. So it turned out to be about 7 years before the program was actually making money. And the Permanent Fund continued that for a few years until about 7 years ago, when the CIO at the time, Jay Willoughby, made the correct decision to insource some of this activity, and we've been proceeding down that path since. So 7 years ago, we had 3% exposure, 3% of a smaller number, and now today we're at 15% of about 65 billion, and the target is 19%. The strategy has evolved over time. Our approach since we insourced has been to invest more time and energy in co-investments, in direct investments, in supporting GPs where we can. And I would say that the evidence is that it's working. Certainly the degree of conviction has grown as we've built staff and built capabilities. And so we've got strong momentum, and we'll continue to increase our exposure over time. Now, an important thing to note is that we're not the only ones who feel that way. We're not the only ones who are leaning into private equity these days. And what you see on this page is the result of lots of investors who agree with each other in principle, lots of investors pushing at the same time in the same direction. What you get is trillions of dollars of inflow. And I think this bar chart on the left probably understates reality, but the direction is clear. And the direction and implication of the opinion polls on the right are subjective, but also clear in conclusion. If you have 51% of a population planning to increase and then a bunch of maybes, the outcome is fairly predictable. And that's actually the answer to one of the original questions, which was, are LPs deploying capital in this environment? I'd say the answer is clearly yes. More than that, I'd say that it's really a tsunami. And here on the next page, I'll try to get behind that a little bit. And I've tried to get behind those numbers a little bit on this page by listing some of the contributing factors, but I'll start out with a story, which is that I remember being in a conference room in New York City a couple of winters ago with a lot of different institutional investors. And it was a relatively varied group, at least in terms of institutional type and representation. And there were, for example, some hedge fund allocators that were talking about shifting capital from their absolute return strategy to private equity because they thought there might be better value for fee in that area. And there were two different insurance company CIOs, both of whom said that they were getting pressure from above in their organizations to increase third-party private equity AUM because it was viewed as value accretive for the overall organization, which actually makes a lot of sense if you think about the relative trading values of asset management companies versus more asset-intensive insurance companies. And then there were several pension funds, different sizes, different circumstances, different funding levels, but they were all obviously wrestling with this actuarial dilemma, which seemed to compel them to increase exposure to private equity. So those are all good reasons. Each of them individually had good reasons for taking that action, but I guess it's just worth pointing out that the result of that collective momentum might not be what individuals predict. There are other good reasons to lean into private equity. I think the active-passive debate that consumes so much time and energy and intellectual horsepower in public markets, I think to some degree that question is answered in private markets, where many of us would agree that alpha is created through action in a way that it really can't be in more efficient public markets. And similarly, the agency problem, the challenge is embedded in having individuals, managers run public companies where their interests may not align perfectly with the shareholders. I think that problem is addressed, or at least mitigated, in forms of investment that are available in private markets, but not in public markets. And with regard to supply, it probably is not even necessary to talk about this, because I think to some degree it would be true that if there's enough demand from LPs, if there's enough capital available, somebody will show up with the ability and a willingness to manage that. But there are good reasons for GPs also to lean in to private equity to continue to accelerate the growth of the industry. And the economics are part of that. I mentioned fees and carry here, and certainly it's true that 2 and 20 economics will attract a lot of investment talent, and it has. But the people I know in the industry aren't motivated only by that. There are other factors like the reality that I think private markets can be more agile, more adaptive to changing market circumstances. And these days we're all reminded that markets can change quickly. Private markets can respond to market changes in a way that's more difficult to achieve in public markets, I think. And then lastly, with regard to spinouts, it's just worth noting that the industry has been around for a long time now. We're several generations into the private equity industry, and there are lots of really talented investors who work in large and established organizations, and maybe some of them are bumping into kind of a management ceiling or a glass ceiling, and believe or recognize that the individual opportunities for those investors could be greater outside their bigger firms. So I think that will be yet another factor that contributes to the growth of the industry. And I'll get behind that a little bit more here on the next page. I've started to address on this page what we're investing and how we're investing in the state of Alaska. And I guess it's fair to say that we're part of this tsunami that I was describing earlier. We invested $1.6 billion last fiscal year in private equity. We'll commit or invest $1.6 billion this fiscal year to private equity, and we'll continue to do it the way we have in the past, which is roughly 75% of that capital through funds, and then 25% through a combination of co-investments alongside existing sponsors, co-investments alongside sponsors we haven't yet backed, and also direct investments into operating companies. And we'll continue to embrace these categories, which I've described at the highest level here: enterprise software, healthcare, financial services, all areas where I believe we can continue to deliver attractive returns over very long periods of time, which is the way that we need to think about it since we're managing dollars with a multi-generational mandate. And then I'd say we're cautious in private credit and infrastructure. Actually, that's probably not the right way to describe it. That implies we're not being cautious in other areas. So I'll say, for the benefit of my board, that's not true. Of course, we're extremely cautious in all areas, but and that includes private equity. But in private credit and infrastructure, I guess our level of enthusiasm is not quite as high, and we won't increase. In fact, we're decreasing our pace of commitment slightly in those areas, with a view towards maintaining the same level on a percentage basis, the same percentage allocation level to private credit and infrastructure over time that we have now. So it'll be about 9%, and we'll grow with inflation, versus private equity, where, as I mentioned before, we're growing from roughly 14.5 or 15% today to 19% a few years out. I'll give you some more color here on the. I've tried to provide some added texture with actual examples of practices, themes, strategies that we've employed at the Permanent Fund over the last 7 years since I've been there, and also some flavor for how we see these market opportunities evolving or migrating over time, because, as they say, there's no resting place in a competitive economy. And we think the things that have worked for us in the past will continue to work, but that they can be improved. And I hope will continue to improve over time. And I believe it'll be necessary. So to start with GP stakes, for example, we think that's an interesting strategy. I'm sure you're all aware there are a number of really skilled investors out there pursuing this strategy, and there are a number of funds, and those funds are getting bigger. And we think that all makes a lot of sense, and certainly there's some fundamental appeal connected with being on the right side of the fee and carry trade. And by that I mean it's nice to receive some fees and carry versus just receiving endless invoices for fees and carry, which is a more familiar experience for most of us as LPs. And yet it's not an uncrowded activity. And I contrast that to, for example, a seeding strategy where you're backing the next generation of managers, which I think by its nature is an ever-expanding pool, or at least ever-refreshing pool, because there'll always be new ideas and skilled investors spinning out of bigger organizations, and that strategy still allows you to share in fees and carry as institutions, to the extent that institutions succeed and grow. Or a different way to think about it would be that I think we can bring, as LPs, a little bit more to the table with new managers than more established managers, and in theory we should earn higher returns if we're bringing more to the table. And similarly in co-investments, we like them a lot. I mentioned before that almost a quarter of our capital is deployed through co-investments and direct investments, and that will continue to be the case, but it is crowded and therefore a little bit frustrating. Co-investments have become a little more crowded, especially co-investments that I'd characterize as kind of plain vanilla. So we're not losing interest in plain vanilla private equity returns, but we think because of the crowds there that our time invested in looking at, for example, recaps of proven portfolio companies of existing GPs makes some sense. There are other strategies. Private credit is not as crowded with co-investors as private equity, so we've invested more time and energy in pursuing opportunities there, and hopefully bringing a little bit more value to the table for our GPs. Specialized managers, long holds, this has always been super important to us. These factors have always been important contributors for us. We think we can take it to the next level, and cooperation with other LPs is an area where I think there is tremendous opportunity. I think we've really just, as LPs, begun to scratch the surface, and that intel sharing and coordination through organizations like ILPA, teaming up to pursue co-investments, those activities make a lot of sense and will become increasingly important. But I think even further, there's opportunity that few LPs have captured yet, which is teaming up, creating a platform, owning a business, and actually benefiting from the increase through the growth of enterprise value over time. I think and hope that's the direction that the market moves, and I think that there's a role for the permanent fund in that. But it's worth saying, probably necessary to say, that all of this is based on several assumptions that are probably not safe assumptions in a government context. I'm assuming that we'll have the resources to attract and retain solid investment talent. I'm assuming that we'll be able to work through some sort of forward operating base outside of Alaska. And I'm assuming that we'll be able to invest in the software and services necessary to support the activity. If we do have those resources, I'm highly confident that we'll succeed. If we don't have those resources, a little unclear. So keep an eye on it. Come back in a few years, and I think if we've delivered, it'll be because we've had access to those resources. And I only have a couple of minutes here, so I won't discuss each one of these bullet points. I don't think there's even time to read all these bullet points, and I'm sure you're all very good readers. But I'll try to conclude by circling back to the question that was originally asked, which was some version of, are LPs deploying capital and where? And I would say that the answer to those questions is yes, for sure, and everywhere. The range, the scope, and the depth of opportunity available to limited partners is growing along with the industry and will continue to grow as the industry continues to grow. I hope some of us will have a chance to work on those things together. And for GPs, it's probably worth acknowledging that recent months have been a more difficult time period for fundraising than some other periods in time. But those challenges are clearly temporary. The long-term trend, the secular tailwind, is so powerful here that I think GPs and LPs can confidently expect to continue to succeed and grow with the industry. And I hope that many of us have a chance to work on these things together. So with that, I'll pause. We'll move over to questions. But again, I want to thank Super Return and the others involved, and thank you all for listening in here.